Black Friday doesn't have to look like this. We're doing our annual Black Friday sale with 40% off store-wide. Our biggest discount of the year on our EdgeFinder, our Discord, our trading courses, and more. There has never been a better opportunity to get in on the action. Use the code A1YT at checkout for a 40% off discount.
After a packed news day yesterday, the rest of the week is looking a little slow, so instead we're going to look at some stream highlights from today's live stream featuring TraderNick and Miko, as well as do some in-depth EdgeFinder analysis. So here we are in the EdgeFinder, and I'm going to go through a couple different things. We're going to take a look at two currency pairs, we're going to take a look at the market Heatmap, and we're also going to take a look at the Fed Tracker, our newest feature here in the EdgeFinder. Before we get started, I want to remind you that if you are watching the video and you see that the EdgeFinder is a useful tool and something that you'd be interested in getting, I'm going to remind you that we have our Black Friday sale going on, 40% off the EdgeFinder when you use code A1YT. It's a really useful tool, and I'm going to show you a bunch of different features, but I'm not even going to show you half of what the EdgeFinder can do for you. So again, we're going to jump right into this. Code A1YT for 40% off the EdgeFinder if that's something you're interested in. Go ahead, check it out. Hope you guys enjoy this breakdown. So we're in the score chart summary, but I actually want to start in the market Heatmap. And what the market Heatmap is, it's our biggest movers from yesterday to today. So we can see here we have our major currency pairs. So these are our major US dollar pairs here, as well as our indices, US indices, US 30, or the major indices, excuse me, US 30, S&P 500, JP 225, UK 100, and German 30. So our biggest indices that we have listed in the EdgeFinder. This, of course, is not all the different assets that we have listed. All assets are right here. We can see everything that we have listed in the EdgeFinder, listed in these little boxes here. I'll get to this in just a second, but I'll go ahead and tell you the darker the blue is the stronger the move to the upside, and the darker the red, the stronger the move to the downside. So we can see here USD CHF is actually our biggest major currency pair move to the upside from yesterday to today at 0.9% up from yesterday, while Aussie US is our biggest mover to the downside, minus 1.42% from yesterday. And all of our indices are doing worse than they did yesterday, with the US 30 being the biggest mover to the downside at minus 0.87%. We can take a look here and kind of just scroll through some of these other minor currency pairs and see how much they've moved either up or down from yesterday to today. So we can see, like, for example, our biggest minor pair move from yesterday would be CAD CHF at 0.93%. We can see USD CHF there, like we just mentioned, 0.9%. And a big move to the downside would be something like, okay, again, Aussie US was our biggest move to the downside besides oil at minus 1.42%. You can see that there. NZD USD, Aussie CAD, GBP USD, all big moves to the upside, dropping more than minus 1%. So looking at the score chart summary, I'm going to remove our indices and commodities because I just want to focus on currency pairs at the moment. And we can take a look at all of our currency pairs. We have a few buys, some new buys. Our biggest buy yesterday, I believe, was CHF JPY with a score of +5. I think that was correct. NZD CAD is our new biggest buy with a score of +4. And down here at the bottom, we have the same strong sells with Aussie NZD, GBP NZD, and Euro NZD. These were our biggest sells of the day yesterday as well. But Aussie New Zealand has a score of -9, which is insanely bearish. So we're definitely going to check that out. And I think it'd be worth it to check out a US dollar pair as well. And I think Euro USD would be a good one to look at, just so that we can get an update on US dollar numbers as well as Euro numbers. But let's start with this crazy Aussie New Zealand number, score of -9. Go into our minor currency pairs here. Aussie New Zealand, score of -9. Every single metric that we track here is in the red. So this is definitely looking like a strong sell. Now remember, you can't just solely go off what the EdgeFinder tells you, because going into tomorrow, this might have a little bit of a move to the upside. That doesn't mean that it's not still bearish. What if the technicals are lining up with the fundamentals? That is a good sign that this market is trending one way or another. But of course, markets are volatile, and they could, have a swing to the upside based on some news. They could have a swing to the upside based on, everyone going one way, and then the market just decides to flip and go another way. But let's go ahead and check this out, because this is definitely looking like a strong sell here. Score of -9, like I mentioned, COT data and retail sentiment coming out to scores of -1, and we can look at our sentiment section right over here. Both the New Zealand dollar and Aussie dollar are being favored on the short side at 57.48% short for New Zealand and 70.61% for Australia. So again, both favored on the short side, although the Australian dollar is heavily favored on the short side at 70.61%. Retail traders, on the other hand, are actually long on the pair as a whole. I guess they're buying low and hoping that in some time, by going long, that this pair will rally and start beginning to move towards the upside. So 71% long and 29% short here for retail traders. Our seasonality score, we can see that our all-time, last 5-year, and current year average all sit below this zero line. So historically speaking, all-time and last 5-year, this pair tends to drop in the later months of the year, sitting below this neutral zero line, and that is the case in the current year average as well. So this pair, especially with all of these other metrics and the way that it's trending, could definitely continue to trend even further down in the month of December, like historically it has in the past. Our seasonality is a score, our trend reading is a score of -2. So that means that this market is trending down for sure. So we can take a look all the way back to October 31st, see these price points here, and as they've just continued to drop, a sharp drop up to November 4th. A little bit of consolidation, maybe a little bit of retesting, but looks like in the past couple of days, past 2 or 3 days, it is again starting another sharp decline. Lastly, our GDP growth, inflation, unemployment, and interest rates all have scores of -1, and we can take a look at these fundamentals over here. Of course, we're comparing the Australian dollar to the New Zealand dollar. Are we buying or selling the Australian dollar based on the New Zealand dollar? Which pair or which economy and currency is performing better? And it looks like with all of these scores of -1 that the New Zealand currency and economy is just performing better than Australia's in each of these 4 metrics that we cover. And we can take a look at that right here. Australia GDP growth 0.9% compared to New Zealand's 1.7%. Australia's unemployment sits at 3.4 compared to New Zealand's 3.3. Inflation on Australia is at 7.3% compared to New Zealand's 7.2, and interest rates are 2.85% in Australia compared to 3.5 in New Zealand. So in some instances, it is close, unemployment and inflation being a difference of just 0.1%, yet it is still beating out, New Zealand is still beating out Australia in those metrics. So this is definitely looking like a strong sell here. Now, the other pair we said we're going to take a look at is Euro USD. This is sitting at a neutral -2 score, so it is leaning towards the downside. But taking a look at this, our trend reading, actually, and taking a look at this price chart, trend reading +2 means that this market is trending upwards fairly confidently. What's really dragging this score down is our fundamental section. So we'll get to everything in just a second. Score of -2, like I said, COT data is neutral. And both of these pairs are heavily favored on the long side. US dollar 77.16% and Euro 65.07%. So institutional traders are fairly heavily favored long on the Euro and very heavily favored long on the US dollar. Retail traders, on the other hand, going the opposite direction. They are short on the pair as a whole, 61% short for retail traders, giving us a score of +1 here. I should mention that our scanner output summary gives a written written summary of why we score these things the way that we do. So if you'd like to know why COT data is coming out to a neutral score and why retail sentiment is coming out to a plus score, read up down here on why we score the things the way that we do. You can feel free to pause the video and read up on that. But I'm going to continue moving on. Seasonality has a score of -1 because historically speaking, on our all-time average and last 5-year average, historically speaking, this pair tends to be under this zero neutral line. However, your current year average is not matching up with that. It is actually above that zero neutral line. But what we can also see here in seasonality in the all-time and last 5-year average is that from October to December, this pair does tend to trend upwards, which is exactly what we're seeing here with this move to the upside from October to November. So historically speaking, again, we could actually potentially see this pair continue to move to the upside moving into December. Right? So now we're getting to our trend reading in our fundamental section. So this is where it gets interesting because this pair is definitely trending upwards. A score of +2 is a strong score. And we can see that from November 4th all the way to today, we've had pretty much nothing but moves to the upside. What's dragging this score down is that fundamentally speaking, this pair should be moving down because we are comparing the euro to the US, and the US dollar is just beating out the euro in all 4 of these metrics. We can take a look at that here. Euro GDP growth, 0.2%. US dollar GDP growth, 2.6%. Euro unemployment, 6.6% compared to US 3.7%. Inflation, 10.6% compared to 7.7%. And interest rates, 2% compared to 4%. So again, fundamentally speaking, this should be very bearish for the euro when comparing it to the dollar. But trend-wise, this pair has been trending upwards. That's why the EdgeFinder is a great tool because you're getting all sides of it. You get a little bit of technical by taking a look at the daily chart, but you're also getting the fundamentals right here. So it's important to look at both, and the EdgeFinder pulls in all sorts of data from all sorts of different places so that you can have the most information possible when getting ready to take a trade. So leaning towards a sell with a score of -2. However, if it continues to trend upwards and maybe with some news events that change some things, we could see this pair start to flip. Now, let's look at the Fed tracker, which is our newest feature that we've added to the EdgeFinder. And it's a really, really cool one because we have our inflation rate forecast and our interest rate forecast. So based on all the data that we're pulling into the EdgeFinder, we can actually forecast or predict what we believe interest rates and inflation will be moving into the different quarters of next year. Of course, we're talking about US dollar right now, US dollar impact, stock market impact, and gold impact when it comes to the US and the Federal Reserve. So inflation rate and interest rates work hand in hand. The higher inflation, in order to combat high inflation rather, interest rates have to be raised, and that is the biggest way that the Federal Reserve fights high inflation. So our inflation in the US, as we just mentioned, is fairly high at 7.7%. Interest rates currently sit at 4%, and we believe that moving into Q1 at the beginning of the year, that interest rates will be raised 1% up to 5% to help combat this high inflation and hopefully bring it down to 6.9%. We believe that, or the software is predicting that interest rates will stay at around 5% as inflation continues to move down. Now, of course, if inflation doesn't move down as much as it predicts, then interest rates could be raised even more. 25 basis points, 50, 75 basis points, up to 5.25, 5.5, or 5.75%. Potentially, maybe even another whole percentage up to 6% to really get this inflation down. But as of right now, if we're talking Q1, the EdgeFinder is predicting 5% interest rates to help combat that inflation and bring it down to 6.9% by the end of Q1. Now, and we can see that same data right here, just in a numerical format instead of the bar chart. Same information, Q1 interest rates 5%, and inflation rate down to 6.9%. This is, of course, the forecast. Lastly, all right, so US dollar impact, stock market impact, and gold impact. This is a really cool feature, and these arrows make it super simple to understand how exactly these markets or currencies, or in this case, even commodity, we have currency, indice, and commodity here. How these different metrics affect the price and the strength of each of these items: the US dollar, the stock market, and gold. So, typically speaking, GDP growth is good for dollar strength. That makes sense. The economy is doing better. The dollar is going to be worth more. So up arrow, as GDP growth goes up, good for dollar strength. Makes sense. 2.6% GDP growth right now, seeing it as bullish for the dollar. Inflation is tricky because interest rates, like we just mentioned, inflation and interest rates go hand in hand, and higher interest rates are actually good for currency strength. So as long as inflation doesn't get too out of control, higher inflation can theoretically be a good thing for a currency strength because it means higher interest rates. So right now, 7.7% inflation is a little bit high, and we're seeing that as bearish. But if inflation gets even higher and we have to raise interest rates like we are forecasted to do, up to 5%, that is a bullish thing for the dollar, and that is good for dollar strength. So high inflation can be a good thing for currency strength when it comes with higher interest rates. Unemployment, on the other hand, more people unemployed means that less money is being spent, less money for the economy. So, of course, higher unemployment, less people with money, that is a bad thing for currency strength. Currently sitting at 3.7% unemployment, which is looking bearish. And lastly, money supply, same thing. Higher money supply is worse for dollar strength. But right now, it's not too bad, seeing it as bullish. Stock market impact. Again, same thing. GDP growth is great. Of course, when we're talking stock market, we're talking about U.S. business. So as U.S. business does better, U.S. economy grows. That's a good thing for the stock market. Higher GDP, higher the impact for the stock market. 2.6% bullish reading there. Now, this is where things start to get a little tricky, and can it get even trickier when we're talking about gold. When traders are investing, do they want to put their money in the dollar, or do they want to put their money in stocks? So are you going to bet on the dollar as a currency, or do you want to bet on the US economy? That's two different things. So again, like we just mentioned with the interest rate thing, high inflation can lead to higher interest rates, which is a good thing for currency strength. Not a good thing, however, for economy strength, for stock market strength. So inflation, as inflation gets higher, that's a bad thing for stocks. Same with unemployment. That kind of makes sense with the dollar and the stock market. More people unemployed is going to be worse for the economy. That's going to be worse for stocks. Interest rates, same thing. Higher interest rates means that stock market is not going to perform as well. But on the other hand, higher money supply, more money out there, is actually a good thing for stocks. And really quickly, going to touch on gold. Gold is like a safe haven commodity for when the dollar isn't doing as well. That's typically what tends to happen. As the dollar is hot and strong and doing really well, gold is doing the opposite. But if the dollar is weak and not performing well, people don't want to put their money in the dollar. What do they turn to? They turn to gold. So the dollar and gold typically work as an inverse relationship, where when one is doing well, the other is not, and vice versa. So strong GDP, better economy for the dollar. People want to put their money in the dollar. People want to put their money in stocks. People don't want to put their money in the safe haven gold. Inflation, high inflation. If inflation starts to get out of control and actually starts to ruin dollar strength, people are going to take their money out of the dollar, out of the stock market, and they're going to put it in gold. Unemployment, that's the same thing. As the unemployment rate goes up and the economy isn't doing as well, people want to turn away from stocks and bonds and the US dollar and turn to safe haven gold. Interest rates, on the other hand, as interest rates go up, that is a bad thing for gold. And then money supply, more money is better for gold. So that was a quick look into some of the different features that we can do here in the EdgeFinder. It is such a useful tool for traders. It tracks so many different metrics and has so much useful information. Again, we are running our Black Friday sale. It is our biggest sale of the year, which means that there has never been a better time to get the EdgeFinder for yourself. 40% off this tool with code A1YT. The links are down in the description if you want to get it for yourself. Again, this is our biggest sale of the year, so you're not going to get a better price on this software than you are right now with code A1YT, 40% off. Go check it out for yourself.
Let's see, where do we want to start? Let's go look at the dollar first. What's happening with the dollar here this morning? So let's start fresh on the US dollar here. We're looking at the 4-hour chart. And, I've recently been talking about how the dollar looks pretty dang bearish. And the question is here, are we going to actually see resistance hold? Now, if you're a dollar bear, right, you might expect this thing to continue to roll over. And I think right now it does sort of look like it has that potential. And I'll give you guys my full take on this. If you've been tuning into the streams and you know my positions recently, I did get stopped out of a trade here this morning, which we can talk about. Maybe you guys can make me feel a little bit better about a loss I took this morning. This is trading after all. Everybody takes losses. The difference is, right? I think I say this so often, and I know I sound like a broken record, but I say it for the new traders who are just tuning in. Every trader, I know, every professional trader, they all take losses. It's not about if you take losses or not, because everybody's going to be wrong sometimes. The difference is, what do you do to control your loss size, and how do you make your winners bigger, right? You're trying to maximize your wins, minimize your losses as a trader. When we look at the dollar here today, what I think is you've got this level of resistance. Price may want to retest deeper. If it does break out of that level, your next zone could be that 50% mark. And then, maybe you see some sellers come in there. For me, this would be bearish. This market is bearish from a technical analysis perspective. Now, fundamentally, we disagree, and we talked about this yesterday. For me, fundamentally, the dollar is not necessarily weak, right? In fact, if anything, it's sort of still strong. You still have the Federal Reserve expecting to raise interest rates, although it's been challenged recently with the most recent CPI number coming out as less than expected and really good news for equities markets, etc. We've seen the fundamental analysis side of things kind of shift to more of like a neutral reading almost, whereas the technical analysis looks very bearish. So for me, the dollar doesn't have like a clear enough directional bias to really be trading it. But from a technical analysis perspective, we have to give credit where it's due. We've got lower highs coming into this market. This market seems to be trending to the downside. So on rips, we're looking to sell into that, if anything, right?
With the daily and the 4H breaking structure, I'm actually a bull in this market for Euro USD. So I'm seeing this downside here for Euro USD as retracement, and I'll be anticipating the market to find some feet again and head back higher. Same thing for pound as well. If we can come back down to some of these areas, I do think pound can push a little bit higher, maybe to 1.21, which is where the monthly level is. And Euro USD, we've got 1.06, which is where the monthly level is as well. We could still head high into those areas before maybe having that larger downtrend continue. So Euro USD, I'm looking at buys for this one. I just want to see a bit more retracement. On my weekly analysis, if you haven't checked out that video, feel free to go and do so. It's on my channel. I was talking about 1.02, and I'm still keen if we can get there to look for some long opportunities to take this higher. Right now, price for me is a little bit corrective. It's consolidating. We've had a very strong move to the upside here. So prices right now is kind of running out of juice and looking to collect some more buys to go higher, if it wants to go higher at least. So yeah, right now it's correcting, consolidating, might see a move down, which is what I'll be looking for to buy it back up again. But yeah, long term, yeah, I can see Euro USD heading down back to the lows. But right now I'm a buy. We've taken out some key structural highs here on the left as well. So as a person who trades structure and always uses structure to buy, sell, to base my bias from, I'm always going to be looking to buy when the market's making higher highs and higher lows. and vice versa.
Make sure you guys check out the links in the description if you need broker recommendations, access to our free Discord, or want to chat with us on Telegram. If you're interested in our trading software, the EdgeFinder, you can find that in the description as well. Thanks for watching.